All right. Well, it's 10 o'clock here, so we'll go ahead and get started for the sake of time. Thank you all for joining us today. Really wanted to put this together given all the market volatility that we've seen over the last couple of weeks. And, we've had a lot of calls internally as well about this, but wanted to share it with the larger group as well. For those of you who don't know me, my name is Taylor Morgan. I lead our wealth management team here in McLean County. Joining me on the call, we have Matthew Lage, who's an advisor on my team, and then Derek Sasveld, who many of you may have heard from in the economic update meeting that we put on for the Gold Timers in November. So really just wanted to kind of pick Derek's brain, get some thoughts from him, talk about a little bit about kind of what we're doing with our portfolios here at Busey as well. I think one thing I'll mention is, none of this is intended to be taken as investment advice because everyone's personal situation is a little bit different. But if anybody has any questions or want to connect with us afterwards, you feel free to email myself directly, or you can email the whole team at goldtimers@busey.com. Throughout the presentation, if anyone has any questions, feel free to use the chat box there in the bottom right. We'll try to address those as we go through the meeting, but if we don't get to them, we'll address as many as we can here towards the end. So with that, Derek, I'll turn it over to you. If you want to share your screen, are you able to do that, or do I need to pass this over to you?
I think I can do it. Let me just share right here and see if that works. Okay, you should be able to see that.
Yep, it's coming through now. There we go. Yep, perfect.
Okay. I have enough material to go through, for a while, but I'd like this to be as interactive as possible. So if you'd like to leave a chat question, please do so on the right-hand side. Also there'll be an opportunity at the end to talk and take questions. I'll step through the early part of this material pretty quickly, but I'll focus a little bit more on the stuff at the end, which is what we're doing and where we see opportunities in markets. So this is probably I would say the third most turbulent period I recall in my investment career. I've been investing for about 35 years. So this isn't quite like the crash of '87 when I was in high school, but it is, I think, behind what happened in the financial crisis and what happened during early COVID in terms of market impact. But I think investors are a lot more capable and interested in making decisions around what's occurring at the moment, because we're getting an opportunity to take risk here, I think, a little bit, and we've done so in our own portfolios. We came into this episode a little lighter on risk than typical, and so we actually bought equities in the early part of last week and benefited a bit from the bounce that we saw. So, but we'll talk a little bit about what's occurred so far this year. I'm sorry, there are a lot of returns on this page, but I'll just ask you to focus basically on the three columns in the middle of the page with returns. So basically, the peak in the U.S. stock market was February 19, and from there to the bottom, which was Tuesday, the 8th of April, the big two negative days, as you may recall, were the 3rd and 4th of April, which were Thursday and Friday. We saw about a 20% drawdown in the stock market generally, with mid caps and small caps falling a little bit more. That's pretty typical in these types of situations. It's unusual for mid and small in the U.S. not to participate, even though I think it's fair to say that bigger companies are more affected by tariffs. And obviously in the wake, so this decline began in mid-February and isn't just about the tariffs, right? So Treasury Secretary Bessent sort of notoriously about 2 weeks ago mentioned that we don't have what we have in markets is a Mag 7 problem, not a MAGA problem. I think that's a little unusual for a Treasury Secretary to say something like that, but he was just highlighting the fact that we came into this episode overvalued in stock markets. And the last time we spoke, I mentioned to you folks that yes, there was narrow leadership in the US stock market, and value and mid and small companies and non-US companies were a lot cheaper than US large caps. And now large caps have responded. And you'll note that non-US stocks, EFA shown here, is basically developed countries outside the US. So that's predominantly Europe and Japan. Over this episode, since mid-February, down 8.5%. Year to date, actually up relative to negative performance in US markets. This is partly due to currency because the US dollar has lost value, but also because those securities came into this episode a lot cheaper, and they're also just lower risk companies. In the US, we have a higher growth, higher risk stock market than most other country stock markets. And so even though the growth hasn't been there in foreign markets, during periods of pullback like this, foreign markets have helped, and they've helped diversify our portfolios for our clients. Emerging markets have done less well than developed markets year to date and in this episode. So, we've seen some cushioning from non-US securities. And then in fixed income, we've basically, had a lot of movement in longer term yields, which we'll discuss at the tail end. But in essence, treasuries have benefited from falling interest rates generally, which they do when markets go risk off typically. I think what's most interesting to us is that over this episode, high yield has actually performed reasonably well. Municipals are extremely attractive at this point in time, and we'll get to that in a second. But higher yielding securities or speculative grade bonds, we think, are not as attractive as some other opportunities. The last time I spoke to you folks, I think I mentioned reinsurance or catastrophe bonds, which continue to yield 13%, which is much better than high yield at 8 to 9. But high yield is now, corporate high yield in the US is now beginning to yield more attractive levels. On a risk-adjusted basis, we think corporates are probably, lower risk corporates are probably a little better at this moment. But, there is some income there, and it's beneficial. But municipals on a tax equivalent yield basis are good and very attractive, especially relative to taxable bonds. And even if you can't benefit from the tax exemption to muni, it's actually still reasonably good as a crossover asset. So we've had a pretty big shock to markets, mostly from tariffs, but also because we came into this episode overvalued. And this is not unusual. So in any given year, what this chart represents, it shows the annual returns in the gray bars in the S&P 500. And then the red dots represent the worst that the market performed during the year. So there were pullbacks, negative pullbacks that you can see under this zero axis. And in every year, there are significant pullbacks in the stock market. Typically, the stock market can lose about 10% a year at any time for any reason. So that's the nature of volatility, and that's what you get paid for, to take risk. And the compensation from stocks doesn't come free. It comes at some level of this drawdown. Now, this episode is a little different in the sense that it's a bit of an own goal. This is a policy decision, and it was intentionally taken to help restructure the economy, the US economy and the global economy. So it's a little bit different from, say, companies going through a tough time or the economy going through a recession or something like that. We don't necessarily have a recession yet, and we don't necessarily expect one. So this is a little bit self-inflicted, but there are buying opportunities in every year when markets decline if circumstances are right. Not every decline is a buying opportunity, but you can see that in any given year, there are some pretty big declines in the stock market. And generally, the stock market has historically fallen about 5% or more, about 3 times a year, 10% or more about once a year, 15% or more about once every 3 years or so, and then 20% or more about once every 6 years. That's in deep history. That's going back to basically the end of the Second World War. The problem is that over the last 6 years, we've had plenty of volatility. So what I'm showing here is, this is the Standard & Poor's 500 in the US, large cap stock index. And the blue periods are when it's rising, the red periods are when it's falling, and these declines. Right now, we're looking at, this is a little bit dated in the sense that the stock market fell from its peak by 19%, and now is down about 13% since February 19, since we've had a little bit of recovery here because of some flexibility in how the tariffs are going to be applied and when they're going to be applied. But you'll note, we had a 34% drawdown in early COVID. We've had some significant drawdowns during the beginning of the Russia-Ukraine war. And we now have a pretty significant drawdown here. So, this was after a period after the financial crisis of, roughly 10 years where there were only modest interruptions to what essentially was a strongly growing bull market. And even since, even over the last 6 years, we've seen a positive return in the S&P 500. You can see the slope here. The trajectory is positive. So even though there have been some pretty big interruptions over the last 6 years, I would view the last 6 years as probably a little atypical in terms of what we've seen in markets. And so, we're weathering some of that volatility now. But for long-term investors who have been investing since the financial crisis, there's plenty of gain that we've had and strong returns over the longer haul. And even again, positive return over this period, which has been more turbulent for the reasons I mentioned. The unusual thing about markets is that big up days and big down days tend to happen together. And this episode was no different, right? That we were down 10% in the Standard & Poor's 500 on Thursday and Friday after the tariff announcements. And then when there was some tariff reprieve, we had essentially about a 9% bounce in the broad US stock market on the following Wednesday. And then we've had sort of mixed markets in between with a little bit more downside than upside since. So these big moves on a daily basis in both directions tend to happen in close proximity. And that's the nature of uncertainty and the uncertainty we're going through, and to some extent, volatility in the stock market. I think many of you have seen this before, that long-term investors should stay invested. Even though I said that we came into this episode underweighted, in a typical 60-40 portfolio, we were still, about 56% equities. So, we remain largely invested in stocks at most times. It's just when markets give us some opportunities to rebalance portfolios or to add to risk a little bit around what our investment policies are, we take advantage of those dislocations. And I would suggest that investors should do that just as they do that with individual stocks and other things in consultation with their financial advisors. But you'll note that if you're invested in all the days of the stock market since 1994, it's a 30-year period, you would have achieved a significant level of wealth. By missing the best 5 days, you lose about 37% of that wealth. By missing the 10 best days in 30 years, you lose about half of that wealth. And by missing the 30 best days, you're down about 83% versus what you would have done in a buy and hold. Now, if you missed the 10 best and worst days, so it's not just one-sided, you would have come out a little bit ahead, but not by much, right? So, we don't view what we do as timing markets. What we do is buy on valuation. And when prices fall and we think valuations are more attractive, we adjust. And I think that's an appropriate thing to do. In the longer haul, and this is not always true in every stock market, but in the US, it has certainly been true. Over the longer haul, generally the good years and the bad years, or the bad years tend to be followed by good years and recovery in the stock market. And so over the longer haul, over 5-year periods or 10-year periods or even 20-year periods, the amount of potential loss that people see in their annual returns, tends to focus around general expectations. So those outcomes can be variable in the short run, 1 year in particular, with big downs and big ups. But if you're patient over 5 or 10-year periods, there's enough growth in the stock market generally, and the U.S. market has been very growth oriented to deal with the downs that come when they come. Now let's talk a little bit about the tariffs. As announced, the tariffs, represented a big surprise 2 weeks ago, a negative surprise for markets. So I would maintain that when the president said that the tariffs were likely to be reciprocal, that markets were assuming a much lower number than what came out. Obviously, we saw a 10% baseline for all countries, and then some countries had surcharges. I think it's reasonable to expect that we will see negotiation. Negotiations are already underway, with a number of countries, and obviously the tariff level changes, right? So right now it's probably between 10 and 15% blended amongst countries, given the 90-day pause, but the increase in some countries, China in particular, and then individual sector tariffs of 25% for steel, aluminum, and a variety of other things. And there are plenty of exceptions. This tends to happen when policies like this are implemented, that there tend to be exceptions for people who have the ability to get them. Apple Computer had significant difficulty last week, and so there was a decision made over the weekend to give a reprieve to smartphones and other electronics. There may be more exceptions that come. This doesn't really reduce uncertainty that much, and that's probably why we see markets down to some extent even today, where basically, NVIDIA was forbidden to sell certain chips in China, and they thought they had received, an exemption for selling those chips, but that decision was made and that changed late yesterday. And so as a result, we see markets reflecting that today. So there's still plenty of uncertainty about where tariffs will end up and what trade policy will be. But it's important to remember that in the US, trade is a small part of the economy. Basically, if you looked at the total size of the US economy, which is about $30 trillion in nominal terms, the vast majority of that economic growth is driven by consumption. Many of you may have heard this before. To some extent, this is households, but it's also businesses and business-to-business transactions. And consumption continues to be the main driver of our well-developed, mature economy. There are other elements, and we saw some benefits from state and local government spending since COVID. And we've seen some investments here and there in fixed investment, ex-housing, and so on. And housing is a relatively small part of the economy, which is growing more slowly than usual, but it also does affect some consumption. When people buy a new house, they buy new stuff because they can, and they have space to have their stuff. So consumption is somewhat linked to housing. Housing is a little bit more important than just 4%, but it's still a relatively small portion of the overall economy too. So it's best not to focus too much on trade. It's important to think about where are consumers and are they healthy or not. The labor market is still reasonably strong. It may soften at some point, but we've seen reasonably good job numbers, and we've seen consistent wage growth. Wages are growing at about 3.5% per year by the best quality estimates. That's that's not superstar wage growth, but it's pretty good. And so consumers up until now have been willing, in the lower end of the income scale, to take on some debt, and in the upper end of the income scale still have COVID savings left over. Those COVID savings are being depleted, and people may get much more nervous about their own personal circumstances if unemployment begins to rise markedly and or the labor market softens a lot, but that hasn't happened yet. Household debt to income, in terms of the difference or the ratio of household debt to household income, is way below its historical average, and certainly below where we were in the financial crisis, where that was a big risk. And so to some extent, households can take on some debt. They have the ability to do that because their debt service is not so expensive. And indeed, there's been a rise in credit card debt and other revolving debt, and some of this is increasingly delinquent. So this bears watching, and if consumers become uncertain in the current environment, that would be a negative sign for economic growth. I don't think we need to have a recession. I wouldn't expect a recession. I'm not an economist. But from what we see in the broad economy and what measures we typically look at, tariffs don't have to cause a recession. But if there's this negative network effect from businesses and consumers in pulling back and becoming more cautious, that's entirely possible that could happen. And investors and households generally have pretty high cash balances in some of their investment accounts. That's certainly true at our institution, where there are pretty sizable money market holdings by our investors. So there's a cushion of safety that a lot of savers have. The problem is, those who don't have significant savings don't have nearly as much cushion, and they're seeing some risk in what they do. I wouldn't want, this chart is a little confusing, but basically it talks about, and I would focus on this box on the top left, namely that when consumer sentiment has been at its lowest points, that's been followed by strong stock market performance. And that's generally because, in my experience anyway, I always take consumer confidence surveys with a grain of salt, because people generally look to the stock market and see what the stock market's doing and kind of cue off of that and take cues off of that. If the stock market's falling, they tell surveys that they're less confident about the future. If the stock market's rising, they generally say, I think things look pretty good. And so the performance after, divots in consumer sentiment are pretty correlated with divots in the stock market and pullbacks in the stock market. And so that recovery in the stock market isn't necessarily because people change their minds. It's because the stock market reacts to being cheaper and companies make different decisions, and some of the ability of stocks to perform is cyclical. However, if we do see a reduction in uncertainty, we will likely see strong recovery in the stock market. This measure of U.S. economic policy uncertainty has been published for about 20 years. And Baker, Bloom, and Davis, who are three economists, went back to the mid-1980s in their early estimates. And you'll note that this is, at least in terms of economic policy uncertainty, we're basically only behind COVID and the financial crisis in terms of previous peaks of this kind of uncertainty. You've probably all heard the U word, uncertainty, in the news, and that's because we are certainly in a period of elevated uncertainty. What these folks do to get this measure is they basically just do a search of news articles and, in essence, tabulate how often words similar to uncertainty are used to describe the environment. So it's called natural language processing, and it's done by a lot of folks, especially in AI, but it's been done by Baker, Bloom, and Davis for quite a while. After periods of uncertainty spikes, and when uncertainty heals and goes away, basically you see better stock performance longer term and for longer periods, after bigger uncertainty shocks when they heal. So we would expect some recovery here, but we need uncertainty to go away. And we need the tariff uncertainty to be resolved at some point. That could take a while. This episode may not necessarily be over, and we may not look at a quick recovery necessarily. We could be talking about this and dealing with this for another 6 to 12 months. But the trajectory, I would suggest, is positive, and there is a potential for recovery. And we've already seen some of that, but I'd expect to see more in the future. We look at the stock market basically as investors who follow valuation. Our notion of what the S&P, or sorry, this is the MSCI USA index, our notion of what U.S. stocks are worth was behind what the U.S. market was, or what investors were willing to pay. And so the last time I spoke to you, I said, the broad stock market is overpriced, but we believe we know where more attractive values are. And I listed those things as, value equity, non-U.S. equity, and especially mid-sized companies. And at the worst part of, at the end of, or on the 4th of April, we had fair value in the U.S. stock market within a reasonable range of where price was. So price was about 13% higher than fair value. In our history, it's been maybe as high as 40% above fair value in certain periods. So that's a significant discount to what it has been trading at. And you can see that in the difference of the blue line, which is our valuation, and the gray line, which is the broad stock market valuation. So we might not be done with this episode, and there could be some more downside to bring us to fair value or below. But I wouldn't expect that in this case, because we haven't seen, and we're not expecting, recession and a really dangerous business cycle and consumption cycle. But if that changes, we certainly would let this audience know if necessary. One of the things that could help us is if the Fed cuts interest rates. Currently, the expectations are for the Fed to start cutting in September. That was originally expected to be maybe June, but that it could take a while, right? So the first cut in terms of market pricing, and I don't do a lot of Bloomberg screen captures, but this is helpful in this case. We could see a cut in June. Markets are expecting definitely at least one cut by the July meeting. The Fed can cut rates in between meetings, but they typically don't unless it's a super crisis, like say the financial crisis in 2008, when they did do things immediately. And you'll note that basically by the end of the year, markets expect 3 cuts of 20.25% apiece, which would take us down to roughly, about 375 in terms of the short-term yield, and that would probably depress longer-term yields a little bit too. The Fed could do more. Originally, in the wake of the tariff announcements, markets priced in about 5 cuts, but that's down to a more reasonable number of 3 to 4, in part because the Fed has pushed back, and the disagreement between the White House, where President Trump, actually messaged out on social media, we need interest rate cuts now. That was on Friday the 4th. And the Fed responded, and the Fed Chair Powell responded by saying, we have no interest in doing that because there are still inflation risks. And if tariffs result in inflation, greater inflation risk, that's a problem for the Fed, and they need to keep that in mind. And that's why they've been reticent to help out in this case. One other thing that we tend to look at, and a lot of people tend to look at for sort of recession likelihood, we have a positively sloped yield curve. The yields for 10-year bonds are well above, about 0.5% above the yields for 2-year bonds. We were in an extended period in 23 and 24 where yields were flipped and there was an inversion in the yield curve. Namely, 2-year yields were above 10-year yields, which typically doesn't happen and is usually a very strong recession signal. That's one reason why people were talking about recession in the wake of the bear market that we had in 2022. But it didn't occur, and this is now much more healthy by measure. So I would just close with some just general points about where we see opportunity at this moment. So tariffs are certainly a negative shock, but the economy actually was okay coming into this situation. And the economy has been, the US economy in particular, has been awfully flexible in the past at dealing with, negative shocks like this. Even in the wake of the financial crisis, there was pretty strong recovery, especially after 2013 in financial markets and in the economy generally. So with regard to the tariffs, negotiations are already underway. We expect that to continue to soften the blow from the original negative surprise. The Fed will get involved at some point to eventually cut rates, but that may not be as aggressive as originally expected. And it's tempered by how much inflation comes through tariffs. So, the economy is resilient and was in decent shape. As we just showed you, consumers are, pretty healthy, even though the lower you go on the income scale, maybe, there are some issues. But if there is, and there certainly is business caution, right? So businesses are waiting and seeing and dialing back investment expectations. So their CapEx or capital expenditures have become a little bit more modest, and surveys of CEOs indicate a lot more caution about the current episode than households are, respond with and regular folks respond with. So if that increased caution by households and businesses occurs, if this is a longer serving episode, or if the tariffs get worse, which they could, there is uncertainty about that, then, that would make recession much more likely. But as of this point, we're not expecting that to occur. That's not our expected case. There are other policy initiatives that are happening. So, the extension of the tax cuts is extremely likely to occur. It's just a matter of when that occurs. And there may be additional tax cuts included in there that turned out to be stimulative for the stock market and the economy in 2017. And there would be some benefit for that. That would be supportive. I also don't think that the spending cuts out of the federal government, which have been slowed by litigation and other issues, have been less impactful than some people feared. And I don't think they're actually that growth negative, but we can discuss that in the Q&A if you're interested. We've taken more risk, as I mentioned, from being underweight to risk to basically being neutral now. And we thought that the U.S. stock market was in a range of fair value at the end of the first week of April, so on April 4. Obviously, there's been a bit of a bounce here. So, I don't think we would be buying more stocks in our portfolios for our clients meaningfully unless there was a significant adjustment in price downward or a resolution of this episode. So we'll see. I think that's pretty binary. But I think we're done risking up for now because we came into this a little lower risk in nature. So if another shock occurs and we don't think recession is likely, and we don't think that earnings in U.S. companies will be materially affected in a big way, then we would take some more risk in stocks. But that depends on on what happens in this episode, how long it is, and how much uncertainty gets resolved. Right? If we have a resolution of uncertainty, then that's how we can get better recovery. High yield credit is yielding pretty significantly now, and the additional yield to treasuries has doubled. So it's gone from about 2.5% to close to 5% extra yield for corporate high yield in the US. So that's attractive. It's more attractive now, but we think reinsurance or catastrophe bonds at yielding 13% are still a better deal, and they're uncorrelated with credit markets and equity markets. So I would reiterate reinsurance or catastrophe bonds as an attractive source of income. That's taxable income, and there can be losses. So the wildfires earlier this year did result in some losses to some catastrophe bond portfolios, not huge ones, but there is the potential for loss. But that 13% yield doesn't come cheaply, but it's superior to what's available currently in corporate high yield. And municipals are attractive on a tax equivalent yield basis, and even to some extent, just as a crossover asset, even if you don't give it extra benefit for being tax exempt. Muni markets tend to convulse every 2, 3, 4 years, usually around periods in which the tax code is being rewritten. And so the fact that we have tax legislation in front of Congress that's being debated and adjusted in the House and the Senate, you may recall that in 2017 there were significant tax changes made to state and local tax deductions, and that affected muni market pretty significantly. And so we could see some other effects from this tax rewrite, but assuming that not a whole lot changes and we basically just see an extension of the 2017 tax cuts, municipals are looking quite attractive and are offering investors a little extra yield. So I know we had some questions in the chat. I'll get to those now, and then if people have other questions, I'll answer those in turn. So we had one question, which was, when should I take my required minimum distribution from my 401k? Well, you have to take it before the end of the year. I would suggest that now would not be a great time to take that. As you may note, we just took a little bit more risk in the stock market based on price weakness. So I would not do that out of reaction or panic. I think this current situation with tariffs can improve. We don't have to have recession. And again, there are 3 big supports to the economy. Number 1, consumers aren't stressed. Number 2, the Fed could step in. And number 3, policy out of Washington is a little bit more supportive. The last time we talked, I think I talked about right after the election. I think I spoke about the potential for headwinds to come up earlier from tariffs and a couple other things, spending reductions in the federal government and so on, that the White House is spearheading, and that the benefits from tax cuts and deregulation and some other things that they were planning to do policy-wise weren't going to really flow through immediately. So it was a little more pain up front and benefits to come a little bit later. They've tried to accelerate the tax cut extensions, but we'll see about that. So I think policy is also a net positive and can support recovery. So I would say you should be patient about that, and you have an option to wait until the end of the year. So I would use that option because I think there's probably more recovery in the future than downside. But that's a timing argument. And then I think there was one more question. No, I just see one in the chat. So are there other questions or comments? I did step through some of that pretty quickly. I can go back and revisit it if you have questions about the material, or we can talk about anything else you like. I'm all yours until the end of this call.
Yeah. Hey, Derek, obviously we're in earnings season right now with a lot of companies starting to report earnings from Q1 here. What are you seeing come out of that right now, and kind of what are those companies' outlooks looking like for the most part?
The outlooks and the guidance has been less positive than usual, but companies always manage expectations, and the word tariff is showing up at record levels in transcripts of CEO and CFO commentary during earnings season. I'd expect that to continue. The Restoration Hardware CEO a couple weeks ago had his earnings call and sort of went off on tariffs pretty negatively and blamed tariffs for the performance of his company. But they had already missed earnings even before the tariff announcements. So to some extent, I think these earnings calls and earnings season can be overblamed on the tariff issues, and negative results can be sort of brought forward by companies, and so as to sort of get them out of the way during a period like this when they sort of have a bit of a scapegoat for if they have negative outcomes at their companies. But so far, earnings season has been pretty typical and actually a little bit better than typical. That's largely because the early announcers are financials, and financials generally, when there's turbulence in financial markets, usually large financials like Goldman Sachs, who reported, and JP Morgan and others, they have trading desks at their banks that trade for investors and provide trade fulfillment for people trading. And trading volumes go up during volatile periods in the stock market, and so they've made a lot more money from that. So I think there's been a bit of a bias in the results that have been a little more positive than usual because of financials and how they've managed through a period of good business for them from a trading perspective. But other parts of those financials are a little more cautious. I would expect, again, guidance to be a little more negative than usual for future outlooks, and that could be a bit of a headwind for stocks. But for now, earnings expectations are still reasonably strong. Earnings are expected to grow by about 7 to 8% this year for the S&P 500, and that's achievable. Just remember that when we're talking about tariffs, there is an impact on companies, but when there are policy headwinds like this, we invest in companies, not countries. So, we don't, yes, it's true that we do hold treasuries in some of our taxable fixed income portfolios, but, the U.S. Treasury is still, money good for now, at least. And the companies that we invest in generally are higher quality companies that have good earnings track records, healthy balance sheets, and usually are industry leaders. And those are the types of companies that can weather these storms well. They did in the wake of the financial crisis, they did during COVID, and they're equipped to do it today. U.S. companies are very well run, and they can recover from these price shocks that we've seen. So that would be my response to that too.
Thanks, Derek. And we got a couple other questions here. One of them kind of coincides with you talking about financials and their reporting of their earnings. But one of the questions was, were banks in danger when both stocks and bonds fell last week?
There were some issues in the Treasury market, in the U.S. Treasury market, that created some concerns about liquidity and caused eventually yields to rise pretty significantly. It's not entirely clear what was responsible for that, but in periods of market turbulence, and we learned this in COVID, even low risk investments like Treasury bonds can be a little harder to trade. Okay. And that may be why the president decided to pause tariffs for 90 days. We're not quite sure. And the Fed usually would step in and provide liquidity, but hasn't done so in this case, which we can talk about as a separate issue. So I would say the valuation and the yield changes in treasuries, since they make up the vast majority of bank capital, are worth watching. I don't think that a 20% pullback in the S&P 500 over a 2-month period, although unpleasant for investors, is especially dangerous for banks. The fluctuation in the long-term yields of treasuries is more important. And what we saw was a decline in treasury yields to 3.8% for the 10-year treasury at the worst point on Monday. They've come back on the Monday, the April 7th. They've come back since then, and we're now looking at something like about 4.3%, which is pretty healthy. And I don't think there should be any impact on banks from that going forward in the near term. But I think that's a good example, though, of the flexibility that we have in the system, where the Fed could get involved to support, or the White House could change its tune. And they have changed their tune, I'd like that to be more predictable. I wish we didn't have to go through this, all at once in the measure that we're going through it. The significant imposition of additional tariffs and the uncertainty around that. But at least the White House is flexible about it, and it has shown a willingness to adjust if adjustment is necessary. I think Treasury Secretary Bessent is very credible, and he has a plan, and he has contingency plans, and I think he's deserving of trust, and he's the point person on managing the government's response to what is occurring in financial markets. So I'm positive about that. So I would say no, I don't think banks are necessarily negatively impacted by the performance of both stocks and bonds. The volatility in bond yields could create some problems, or illiquidity in bonds where they couldn't buy or sell or trade perfectly easily at some points, on the 3rd and 4th of April. Those things are more important to banks, and I think those are resolvable as long as the White House is flexible and should the Fed choose to engage.
Another question here, with the market volatility this year, what should we anticipate in terms of capital gains? Will this be a typical year, or could capital gains be even higher this year? And I think a lot of that answer is going to depend on, your money manager that's managing the investments. Derek, can you talk a little bit about what we do here for our clients to help alleviate some of those capital gains concerns?
So we invest for our clients in basically 3 different types of vehicles: individual stocks, open-end mutual funds, and exchange-traded funds, or ETFs. The open-end funds are the ones that would have the most potential for capital gains for any investor, because they have long-term capital gains from the last 2.5 years, that even though prices have fallen to some extent, there are still probably some embedded gains in those portfolios. Also, portfolio managers tend to trade more when there's volatility, because they have more opportunity to exit positions and take profits, and their new opportunities are presented to them through lower prices in some securities. So I would expect that some mutual fund holdings, probably by the end of this year, will communicate that they have taken probably the last of their gains from the last 2 to 3 years. U.S. large cap and mid cap open-end mutual funds, had significant gain recognition last year. In mid cap in particular, about 10%, around 8 to 10% capital gains exposure in a total portfolio. So I think that you've got to be careful about that. Now is actually not a bad time to buy mutual funds, open-end mutual funds, because there'll be enough individual funds that have enough losses that they won't necessarily take gains in the future. Okay, so when prices fall, you could do some of that. For our clients, we tax loss harvest quite a bit, so we realize tax losses, and we did some of this last week, where we had, again, as I mentioned, since February 19, a 20% drop in the U.S. stock market. That allows us to sell some securities that may have been purchased earlier this year, or weren't big gainers in 2023 and 24. And so by selling those stocks that are at losses, and buying proxies or funds or ETFs, and buying proxies or replacements for them that are not exactly similar to what they do, or not exactly the same, we can realize tax losses that then can be used to offset future gains for up to, I think, 3 years in the tax code. So tax loss harvesting is something we do for our clients in stocks and in funds. But basically, open-end mutual funds are the most likely to have gain issues. ETFs, or exchange-traded funds, are traded like stocks. So yes, they can have gains, but after periods of pullback, that's a lot less likely. The open-end mutual funds just have individual stocks inside of them that can carry very long-term capital gains if they're not transacted. So that's just something to watch out for. But again, we spend, in periods like this, we think about okay, what can we buy that's cheap? What can we take profits in? And how do we harvest tax losses? That's basically what we think about. And that's what we've been doing for 2 weeks.
And then it looks like we have one last question here, and Derek, this one's going to be a little bit more difficult to answer without knowing kind of the sector breakdown. But the question is, with a 60-40 portfolio of U.S. stocks and bonds, what do you think performance projections will be for the next 1, 3, and 5 years? years. And obviously over the 1 year time horizon, that's a little hard to predict. As we go out a little bit further, we can kind of hone in a little bit better on that. Still impossible to predict. I know we have some projections of our portfolios here, but for just kind of a typical 60-40 portfolio, do you have any thoughts on that?
So a 60-40 portfolio, I'm just doing some quick calculations here. Hold on a sec. I would expect about, in the long run, I would expect about a 6.5 to 7% return out of such a portfolio. Okay, over the next 5 years, something close to that, and that's in nominal terms. Over the next 3 years, a little bit less, and over the next year could be a little bit more. So I would expect some recovery in the stock market and continued reasonable yields in the fixed income market. Like the best predictor of what your fixed income return is going to be is what the current yield is. Assuming no changes, we could argue either way that the yields could be lower if there's economic weakness, or they could be higher if we have inflation and we don't get deficits under control, and maybe there's a strike of fixed income buyers. So I would expect basically about a 4 to 4.5% return from that bond portfolio if it's low risk treasuries. Obviously, you can take credit risk and jack that up a little bit, but I would expect stronger performance for the next year out of recovery from where we are right here. Over the 3 year period, maybe a little bit less, and then in the 5 year period, annualized, I'd expect something along the lines of 6 to 6.5% out of a 60-40 portfolio. So if you put a gun to my head, I'd say maybe 10% for the next year from today, and maybe something like 4 to 5% for the next 3 years on average, because there is some risk that 2026 will be a little bit more dangerous from an economic point of view. And then in the longer run, and I think 5 years is long enough, 6 to 6.5%. I hope that's good enough.
Yeah, and I think one thing I'll mention here is one thing we do offer the group here is we offer investment portfolio analyses. So if anyone has any questions about that or want us to do kind of a deeper dive in your portfolio allocation and just give a comparison of how we invest here versus how you're currently invested, that is something that we offer to the group. You can either request that by emailing us at the goldtimers@busey.com email address, or if you go to busey.com/goldtimers, there's a little box that you can select to request that too. So that is something that we offer to the group if anybody's interested in that. Other than that, I think do we have any last questions here before we close out? I'll give it a couple minutes, see if any come through. This is recorded as well, so once we get done here, we'll get the recording back and posted probably within the next couple of days. Okay, doesn't look like we have any more questions coming through here, so thank you all for joining us today. We appreciate it, and any follow-up questions that you have, don't hesitate to reach out. We're always happy to help.
Thanks, everybody.
Right. Yep, thanks everyone.